All right, it's tax season time. We're going to show you 6 ways to reduce your taxable income for 2023, especially for a W-2 employer, a high income earner like myself. And eventually we will move on to becoming a entrepreneur or a business owner. That way tax liability is not as strong as we would like it. So stay tuned. Watch this whole video to the end and make sure you get all those tax tips. All right, let's get into it. So number 1 is open up an individual retirement account or IRA or a traditional 401k. That way tax shelters your income. So basically what that means is the amount of money you get gross from your W-2 form from a high income job like myself gets deducted from your income. So that way the IRS can only tax you the amount that's seen. According to this website, irs.gov, you're allowed to contribute up to $6,500 for your individual retirement account. And if you're over the age of 50, you can go up to a max of $7,500 according to the irs.gov here. So a couple of key terms you're gonna need to know. This is just based on the irs.gov website. So they're talking about the thrift savings plan. That's only geared toward government employees, federal employees. So that's what they're referring to here. According to this website, there's a couple of highlights to the 2023 individual retirement plan. So what we're familiar with is the 401k, 403b. If you make more, you're able to put in another form of retirement called 457 plan. So you can have a 401k in addition to a 457 plan, but you can't have a 403b and a 401k together. You can have 401k plus a 457 plan if you had high bracket income as a W-2 worker. And then the federal government offers to their employees a thrift savings plan that can be increased to $20,500, up from $20,500 for 2023. W-2 employee that you should contribute to this kind of savings account. But if you're an employer, you can offer what they call a simplified, simple incentive match plan for employees. Okay, number 2 is start a flexible spending account or a health savings account. This is like money that just not being saved. I don't know why people don't do more of this. Basically what you're doing, you're setting aside pre-tax dollars to pay for either eyeglasses, contacts, dental care, and the above. So there's 2 main types of account. The first one is a flexible spending account. So a flexible spending account is to be used for qualified medical expenses. So like I said, medication, eyeglasses, contacts. So according to Forbes, you can contribute to $2,850 for a health spending account, flexible spending account. It might vary from different employers that you work for. So according to Forbes, they say it's averaging about $2,850. Now the difference between a health savings account, that it does the same thing. It's money set aside to help pay for medical expenses. So according to Forbes, it's another $2,800 for a family plan and about $1,400 for individual. The caveat for a health spending account is whatever is left can be put into an investment. So a health spending account, HSA, can be utilized at the end of the year. If you haven't used it, you can put it into a contribution to different investment accounts. Number 3 is starting at 529 college plan. So it's more beneficial as far as the state taxes. It's not more a federal thing. So it's based on state regulations. So according to Forbes Advisor here, so like using Forbes Advisor. So 529 plans are investments that oftentimes can be used to pay for individual education funds. It could be for K through 12 or for college fund. However, there are limits to it. They're saying technically no limits, but there is quite a limit. It's qualified as a gift according to IRS, which can trigger the need to file a gift potential if you need to. But they're saying that according to this website, is for 529 is $32,000 for married couples filing jointly, and then $16,000 for individuals. So it's a great plan as far as making sure that you have money set aside to contribute to your kids to go to college. So here's some based on state that how much you can contribute up to the limit. I don't know about you, but I don't have $350,000 to set aside in a 529 plan. So that's another tax sheltered idea. Number 4, my all-time favorite, owning real estate that you can utilize to create passive income. So basically you get a check in the mail every month. That's you have a renter or a tenant that's living with you. Or you can house hack, where you live on one side of the building or the first floor of a family house or duplex, and the other side you rent out, but the house still belongs to you. So you can depreciate the property. Depreciation means that the wear and tear that you have to maintain the property for, you can actually write it off as maintenance for the property. So rental property owners, you can depreciate these tax savings, and the usual course of calculation is based on 3.63% in a 27.5 year span. So you can write those off. So a simple calculation will look like this. So an example will look like this. You bought a property for $29,000 in July, and you put it on the market and rent it out. So you can depreciate 1.667%, or $1,650.33. Basically, it's 99,000 times 1.6. You can depreciate the first year 1.66, and the year thereafter you can depreciate 3.6%, or in this example, be 3,559 over the lifetime, over the 27.5 years that you own the property. So it's a great tax savings where you're saving $3,500 based on the property depreciation to maintain the property. So real estate's always been my favorite game. I haven't yet to jump into the real estate business, so I hope to be there soon. All right, number 5 would be take out more taxes, or at least take out more for your taxes. I know I'm going to get a lot of backlash in this department. I mean, I have 2 actual real life experiences where I had to pay back taxes, total $7,000 to $6,000 per year. I know a lot of people out there saying, "Oh, you're getting a big refund because the government been holding your taxes throughout the 12 months, and you're finally getting it back." But I beg to differ, because I have to pay taxes, and nobody can avoid that. So here's a PDF sheet from the IRS, your famous W-4 form. And then it's pretty self-explanatory. Step 1 is fill out your information, Social Security number, and how you're filing. Step 2 is if you have multiple jobs, you can go in the back of this sheet. But then we're going to just keep it simple today. So step 3, you're going to fill in. So I have 2 kids, so it'll be 2,000 times 2 will be $4,000. And additional other dependents will be like an elderly parent or something. You add another $500. So right off the back, I'm $4,000 in. And then this is where you add extra withholding, is right where this is. Extra withholding is where you want to put the. So for mine, I kind of do the calculations through the irs.gov website. In addition to my job, I figured the amount I would need to withhold would be an extra, I think $175 per week. So I get paid weekly check even though I am salary. And then you fill in the banks. It's pretty self-explanatory. So that's number 5. Just take out more. That way you're not paying at the end a big lump sum. All right, you stuck around this long. The last one is start a business, either from home, as you see in my other video on how I started an Etsy account. You can start a business from home. So if you're working from home, however, it's not considered a self-employment, because you're technically working for somebody else, but just that the fact that physically you're working from home, but you don't actually own a business. And the other stipulation for having a business is if you don't make an income, or you have no profit, mostly no profit, some losses, then the government considers your business as a hobby. So you gotta make some kind of income within the first 1 to 2 years. Correct me if I'm wrong, comment below. But having a business and a self-employment business, you can deduct your home office supplies, machinery, any tangible property. So any object that's physically on the property or in the office called tangible property. So those things are tax deductible. They depreciate. They devalue over time. So you can deduct those. And according to NerdWallet here, they're saying that
You can deduct for $5 for every square feet of the business space, up to 300 square feet. So my office is not 300 square feet. I can definitely deduct that. Another deductions would be the retirement plan that as an employer, you would offer a simple incentive to match plan for employees, or simple we talked about earlier. So those can be deductible. Any business insurance premiums that can be deducted on a Schedule C here based on this article. Office supplies we talked about, credit card loans and interest that's used for the business, and of course business and internet, any cell phones used for business purpose, travels and meals can be deducted. And any startup costs, you had to start up the business up to $5,000 up to the cost of starting the business, like establishing an LLC is deductible up to $5,000. So pretty hefty as far as starting a business, and even marketing that you do and memberships that you're part of as far as starting your business, so that all becomes deductible.
If you like these type of videos where we talk about personal finance and cost savings as far as doing stuff yourself, either doing your taxes on your own or either helping you with the house appliance repair, go ahead and subscribe to the channel and leave a comment below. I do appreciate you guys watching these videos. We're about 250 subscribers. Let's get up to 300 subscribers and beyond, up to 1,000 subscribers hopefully by mid-year this year. So I appreciate you, and I'll see you next video.